We have a major flip going on in the market. We're not talking flipping flapjacks here today in this video, folks. Welcome into the reaction channel. So public count up $97,000 here today. Obviously a very big day for the public count, but I wanted to speak at the beginning of this video. Why does your portfolio stair step up and why does it elevator down? We'll speak about that and how a portfolio is constructed and those sorts of things at the top of this video. Then I want to talk about a few stocks that are, let's call it, actually struggling a little bit in regards to their stock prices. One is Meta. So Meta stock today is the same price it was back December of last year. Okay, so I want to speak about Meta, what's going on there in this video. I want to talk about Cake. What's the deal with Cake? We're only up about $17,000 on the stock now at this point in time. Cake's just been kind of bleeding. You know, even on a great green day today, down 2.5%. So what's going on with Cake? We'll speak about that in this video. Nike, when is this stock ever going to go up? Like, it's just been dead money and it just, you know, never goes up. We'll speak about Nike in this video when it starts to move, okay? Then I want to talk about Palantir, Elf, SoFi, Celsius Beverage. Those stocks skyrocketed today. Like, you see the market up 2% or so, right? Celsius up 7%, SoFi up 8%, Elf up 8%, Palantir up 8%. Like, why are those stocks so insane? Like, why are the moves so dramatic in those stocks, okay? Then I want to speak about Duolingo. Duolingo, A+ income statement. Very impressive out of them. Talk about if that's an opportunity or not. Robinhood, A+ income statement out of them. Very, very impressive. We'll talk about if that stock is an opportunity or not. From there, I'm looking forward to reacting to Tom Lee, everybody's favorite bull in this one here today. Tom Lee went on CBC a few hours ago, spoke about his views on the market. I want to share my opinions and perspectives based on that. Ed Yardeni went on as well, spoke about his views on this market, and Stephanie Link as well. So looking really forward to reacting to all of those videos here today. I appreciate y'all for joining me. One thing and one thing only I need from you, if you could please just hit that thumbs up button. You could just hit that little thumbs up button. It would mean the world to me. And for every single person that's already done it and you didn't need me to ask, thank you to you guys. You are the real heroes out there, okay? Additionally, if you want to be subscribed to this channel, you can certainly subscribe. We're now at, I think, 120,000 subscribers or somewhere around there, ballpark. I appreciate everybody for being subscribed here, okay? Listen, here we go. December 14th. That will be the day I am closing my private stock group to new members. It has been overwhelming demand this year. I've been trying to figure out, like, we got to take a break in regards to new members in there. The demand is insane. Like, look at what we're up to now. We are now up to 2,938 members. Demand has been ridiculous. So what I'm going to do is I'm going to close the private stock group to new members on December 14th, which means you really need to apply by like this time because guys are booked out several days in terms of even talking to them to get in the side of the private stock group. So yeah, December 14th will be the big day. And then we'll open it back up at some point in Q1 of 2026. I don't know when exactly, but at some point in Q1 2026, we'll open it back up to new members. But it's been out of control this year. My guys have been just, you know, fully loaded every single day, busy, and I want to give them a nice break. So they'll get to take maybe a month off or so. And, you know, they'll be doing other stuff behind the scenes, but it's just like they'll be able to take a break from just the influx of new members. So pin comment down there if you're looking to apply to join us in my private stock group before we close that baby up to new members, okay? Alrighty, so stair step up, elevator down in regards to your portfolio. Why does it happen, right? What do I even mean by that? Some people may, what does that mean? Stair step up basically means when your portfolio is going up, it's not going up nearly as quickly as when the market went down. And that's what we call it elevator down, right? If you take the stairs down, it's a very slow process. Imagine you're in a 30-story building and you're walking down the stairs. It's going to take you a long time to get to the bottom, right? An elevator, on the other hand, you go straight down. Now, you look at the public count here today, up 97,000. Good day, if not, I mean, a great day for the portfolio. But at the end of the day, like, it goes down faster when the market gets really shaky. And why does that happen? Well, a lot has to do with a couple things, okay? One is the algorithms, right? These algos are so sensitive, and when those algos start getting set off, what you can start to have hit is stop losses. And when those stop losses start to hit, it creates even more selling pressure. When that even more selling pressure gets hit, the algos say, let's sell as well, right? And remember, a lot of the trading is done by algos nowadays. So that's one part, okay? The second part, and this comes down to humans, not machines, okay? Humans, what happens? Fear is a emotion in humans that's much more, let's call it, much more powerful than not fear, right? If I told you, dude, your house is on fire right now, you're going to freak out. What? My house is on fire? What? If I tell you, dude, your house is not on fire right now, you'd be like, yeah, okay, what's the big deal? Good, that shouldn't be on fire, right? And so that emotion in us humans, right, when we hear something's bad or something's going on, you're like, huh, we got to get ready. Like we got to do something here. We got to sell, right? And that selling breeds more selling, more fear, more people talking negative all simultaneously. And that's why you can get the market to go down substantially sometimes. I mean, sometimes you can get the stock market to go down, 20, 30% in regards to Nasdaq, and it can happen in a matter of months. It doesn't need to happen in a matter of years. It can happen in a matter of months. But that fear also comes in. Everybody starts talking negative. Everybody starts getting fearful, right? Boom. And then you add on margin on top. We know there's a lot of money out there on margin. You add all three of those elements, and that creates. Now, meanwhile, on the buying side, right? Buying is much more predictable. People and funds usually come in with their weekly or monthly buys, and People would be willing to sell $1 million of stocks in a day. Most people aren't willing to buy $1 million of stocks in a day, right? Like most people don't say, they don't just wake up one day and they say, I'm going to throw my whole net worth in the stock market. I'm going to throw my whole net worth right now in Meta stock and Tesla and whatever stock, Palantir, blah, blah, blah. But they do wake up and say, I'm scared. I'll sell my whole portfolio today. That happens all the time. Every single bear market that happens. People say, I'm done. I'm selling everything today. So people will invest gradually over a period of time. People will sell their whole flip and flapjack and portfolio in a day. And that creates major, major downside. And it's not just retail individuals. We're talking big money does that as well. Like a lot of hedge funds will just mass liquidate positions. Boom, boom, boom. Some of it comes down to all of a sudden margin calls and liquidity problems and things like that, right? So that's why this situation occurs where, Nasdaq goes down 3%. And Nasdaq goes up 3%, and maybe you got hit harder on the way down than you did on the way up. And you're like, how does that work like that, right? Happens all the time. Meta stock, next up here. Meta stock is being a lagger. Like this stock didn't even keep up with the Nasdaq today, up 1.6%, right? So Meta stock has suddenly turned into a lagger, a dud of big tech, right? When it was one of the best performers, like the stock was a beast. So what is going on here with Meta? Okay, here's what's going on with Meta. People are very fearful of the spend. Zuckerberg's going crazy with the spend again, and investors are getting scared. And for good reason. Remember, the last time Zuckerberg went crazy with the spend was back in, end of 2021 into 2022, and we saw what happened with Meta stock. Meta stock went from a $300-something stock to $88. So naturally, people are going to get very scared when all of a sudden Zuckerberg goes too aggressive with the spend. So they're already pushing back big on this and like, Zuck, chill, dude. You're spending out of control, right? And so Zuckerberg is going to have to keep those expenses in 26 somewhat in line with revenue. Like let's say revenue goes up 25% in 2026, okay? Expenses need to go up 25% or less, basically. They can't outweigh. If expenses in 2026 are up 40% and revenue is up 25%, it's going to be hard to get Meta stock up. It's going to be very, very difficult because people are not going to like that. They're going to push back, and by pushing back, they sell the stock, or they just refuse to buy it, right? Now, with that being said, here are my numbers in regards to Meta. Keep in mind, revenue in the latest quarter, they grew revenue 26%. So even under my bull case, I have a serious step down in revenue growth rates. I have them only doing 20% a year revenue growth, and then 22% net income growth per year, okay? If they have a 20% top line, 22% bottom line, 35 to 45 PE would be fair for the stock. So we're talking about a compounded annual growth rate in the 30s, okay? My base case, this is what I'm expecting from Meta. I'm expecting 15% revenue growth per year. Keep in mind, ladies and gentlemen, that's a mile and a half away. We're talking 1,100 basis points away from where that company's been growing. They've been growing revenue 26% in the latest quarter. I have been going all the way down to 15% on average per year. 18% net income growth on average, okay? 29 to 34 PE. We're talking about, I get a CAGR in the stock in the 20s. Meta's a buy today. It's an easy money buy, right? Even my bear case has them doing only revenue growth at 10%. The company's growing revenue 26%. So to go down to 10% would be a disaster. And then no lift in the net income. So 10% net income growth, 23 to 28 PE. I still get a CAGR that's probably going to beat the S&P 500 over the next 4 years. So my bear case, I still beat the S&P 500 likely. My base case is amazing, 20% plus CAGR in the stock. And then the bull case, if that plays out, we're talking about a 30% plus CAGR. We knocked it out of the ballpark. So the bottom line is Meta stock is a buy right now, today, right now, ladies and gentlemen, okay? Now, in regards to Cheesecake Factory, what's the deal with cake? Okay. I'll show you what the deal is with cake, okay? Like cake, It's almost my birthday, by the way. Did you guys know that? Okay. Where do I want to start with cake? Okay, so let me just pull up. We'll pull up the cake. We'll pull up the cava. We'll pull up the sweet green, which is what, SG. We'll pull up the Chipotle. You guys remember Chipotle? Okay. We'll pull up the Buc-ee's, S-Bucks. And you'll get to see just this industry is just bad this year, man. Bad, bad, bad. So this is a year to date for these stocks. Sweet green year to date is down 83%. 83%. Cava's down. Cava is down 56% this year. Chipotle has basically been cut in half this year, down about 50%. Starbucks is down 8% this year, and Cake's down 5%. No one wants to own anything in the restaurant, food space this year. It's just the way it is. Let's pull up Darden. Let's see if Darden has beat Cheesecake this year in terms of performance. DRI. Darden's a big restaurant player, owns Olive Garden, a bunch of other big brands, Yard House, blah, blah, blah. And Darden has underperformed Cake this year. Darden Restaurants is down about 7%. Let's pull up, in my opinion, arguably the most well-run restaurant chain in all of America, Texas Roadhouse. They might even beat Cake, and that's a hard thing to do. And Texas Roadhouse down, 10.7% this year. So the bottom line is, folks, this industry just sucks in 2025. It is what it is. Some years you're going to, have some stocks in industry, and there's just no momentum. So Cake has such an amazing next 5 to 10 years ahead, right? With the Flower Child expansion, with the North Italia expansion, they got an ATM business model in the Cheesecake Factory, and they got a bunch of concepts they're growing. But with that being said, and it trades at like a 12 forward P or something just silly. But at the end of the day, no one wants to own these stocks in the space. And if no one wants to own it, what are you going to do? You know what I mean? If it's just, the good thing for the Cake, and this proves how great the Cake's business model is Cake is outperforming these other companies. It's done the least bad of Darden, Starbucks, Texas Roadhouse, Chipotle, Cava, and Sweet Green, which means it's seen as defensive also. If you're going to think about who's defensive in the space, it's actually Cake. So Cake has that amazing offense the next 5-10 years with all the locations they're going to be able to expand into for Flower Child, North Italia, and other concepts. But they also are giving you great defense. You could have been in Cake down 5% this year. You could have been in Sweet Green down 83%. Sweet Green might never get back to the price it was at the beginning of this year. And if it does, it's going to take years to get back there. You could be in Chipotle stock down 50% this year versus Cake down 5%, right? So the bottom line is Cake's set up amazing for the long term. It's just no one wants to own those stocks right now. Nike, when does this stock go up? Listen, it is clear as day Nike's business model has turned. The numbers are proof of that, right? But with that being said, if you're thinking about a stock that's remember, Nike's a big market cap, right? If you're thinking about a company that, who do you want to tax loss harvest with, right? Nike's coming to mind. Nike's coming to mind because a lot of people are thinking Nike stock's not going to move up in any substantial way between now and year end. And they're I'm sitting on a bunch of gains. And so why not go ahead and sell off Nike? So even though that company has turned the corner with their business model, everything's headed in the right direction, the stock isn't, because that's facing tax loss harvesting at the end of this year. And so it is what it is, man. It is what it is. It doesn't matter what their numbers are right now. People just are kind of look at that and they're wait, I'm down a bunch on this. I sold a bunch of profits in these other stocks. Sell Nike. We'll buy it back in the first quarter next year. So that's what's going on with the stock like Nike. Palantir, Elf, SoFi, Celsius. Why these stocks go so insane? Why they got to be so drama? You know what I mean? Why? Why? It's just insane, the moves in these stocks, right? Remember, who's in a lot of these type of stocks? You're going to have people like myself that are long-term investors that love growth stocks, right? And if you know what I preach what? GVD. Growth stocks, value stocks, dividend stocks. The three, right? GVD. When it comes to those stocks, they not only attract people like myself that are looking to be in those stocks for years, they also attract, who else? A lot of traders that are in and out of these stocks. Traders can be risk on one day and the next day they wake up and they're risk off, okay? They're in, they're out, they're all over the place. And so if all of a sudden you get a big risk on day, suddenly all these traders are jumping right in. Stock goes up 8%. And if all of a sudden tomorrow everybody wants to go risk off, stock will go down 8%. 9%, 10%, 12%. Like, who knows? Remember that a lot of times the moves on the downside are even much more extreme. And so that's what's going on with those stocks. And remember also, a lot of people that buy those stocks will do it on margin as well, because they already have a bigger risk tolerance being in those sorts of stocks. So they'll play them with margin as well. And then also the markets get shaky, and either they get margin called, so they have to get out, or they just don't feel comfortable being in those stocks. And that's what ends up happening, ladies and gentlemen. So yeah, that's why those stocks are so drawn. It's ridiculous. Okay. Next up here, Duolingo, Robinhood, these two stocks. So Duolingo, A+ income statement here, beast numbers out of this company. Look at their net income. I mean, of course, their net income was helped by this one-off here, so do keep that in mind. But if you look at their income before income taxes, it almost doubled year over year. It went from 25 mil to 46 mil. Very impressive. If you look at their gross profit, it went to $196 million from $140 million. Like, A+ income statement from Duolingo, phenomenal. What's the issue with Duolingo? Well, the issue with Duolingo is there's a lot of fear about Duolingo being somewhat of a fad product, right? It's blown up to be super popular over the last few years, but there's fear that it could be a fad product like GoPro was back in the day, like Fitbit was, and countless other things, and Beanie Babies and all those things, right? And they come and they go. And just like a lot of video games have been over time, right? Like a lot of mobile games, like Clash of Clans was so popular. It's not nearly as popular nowadays, right? And it seemed like everybody was playing with Clash of Clans back then. And now it's not really like that, right? Candy Crush, Soda, Candy Crush, Soda Saga, all those games were so massive, right? And then they weren't anymore. And so you look at something like Duolingo, and we see that maybe that's going to be a similar situation where, yeah, it's been insane and it's so cool and people want to do it, but ultimately at the end of the day, they're not going to want to do it, right? And so that's just something to keep in mind there. The good thing I think for Duolingo that's better than any business model in the past is really around the subscription service, right? If you think about Candy Crush, if you think about Clash of Clans, GoPro, Fitbit, they were relying on a lot of one-time purchases. Duolingo is more of a subscription, right? So even if people aren't using it, they might stay subscribed to it, so that the melt in the business model might be much slower than other ones, right? So that's kind of what's going on with Duolingo. The other one issue you have with Duolingo is, let me show you guys something very important here with Duo. And this is even despite the stock crashing. And remember, I used to have a put position on Duolingo. I did phenomenal in it. I think I made like 50+% in a quick amount of time. It was amazing, right? Duolingo's PE's come down so much. Like last time I looked at Duolingo, like back when I was buying puts on the stock, the PEs were like really, really elevated. And I guess they're not anymore in regards to Duolingo. So I guess can't even say that anymore, right? So, I mean, with Duolingo, the thing is, I wouldn't trust betting against a stock in 2026 or beyond. I just wouldn't, right? Also, it's not a stock I really want to bet on either, but I think the big money betting on the downside, I think it was to be made this year in 2025. So if you bet against Duolingo this year, you should have made crazy money on that. Good for you. I don't think there's easy big money to be made on Duolingo in 2026 betting against it, right? So I just wouldn't feel comfortable betting against Duolingo in 2026. I just wouldn't. It's not, 2025 was the year you could have made bank. 2026, you're pressing your luck, in my opinion. Now the Robinhood, so phenomenal. The Robinhood turnaround's historic. Like, it's unbelievable the way this company's turned around their income statement in the past 3 years. It was dumpster fire trash, like F-grade level income statements like 3 years ago or so. It is not like that anymore. It's A+. And look at total net revenues, up, basically doubled up year over year. Incredible. Total operating expenses was up 31%, but that's nothing compared to how much their revenues are up. Net income was up 271% to 556 mil. Diluted EPS 61 cents. Okay, so what's the issue with the hood? Okay, the hood, in my opinion, has two issues. One, the PEs. I don't care if you're looking at a trailing 12-month PE, forward PE, or 2-year forward PE, they're very high, right? The other big issue the hood has here, and why I'm not buying it despite it having an amazing income statement and balance sheet, the reason I wouldn't step in hood right now is you got to understand we've been in a 3-year massive epic bull market. Massive epic bull market for stocks and for Ethereum and for Bitcoin, okay? All three. Guess how Robinhood makes its money, okay? I don't think it's rocket science to, know how they make their money. look at where their big money comes from, right? Net interest revenues certainly is a big number for them, but transaction-based revenues is the big one, right? Transaction-based revenues, 730 mil from 129, up 129% year over year. The business has been on fire. The issue is, at some point in time, this bull market will come to an end, right? I don't know when it is. It could be next year, it could be the year after, it could be the year after, it could be the year after. At some point, it's gonna come to an end, right? Robinhood's revenues in that environment are going to go down substantially, right? So then you're going to have a whole re-rating of the stock, and you're going to have a nasty crash. Because here's the deal: Robinhood trades right now at very high P ratios. So once the revenue growth all of a sudden starts to collapse, right, the stock price is going to collapse twice as hard, essentially, and that'll not be a good thing, obviously, for Robinhood stock price. And so I wouldn't feel comfortable stepping on Hood here. You usually want to step in on Hood when you've gone through a big bear market. Because when you've gone through a big bear market, no one wants to own some company that makes a bunch of money off of Bitcoin, Ethereum trading, and stock trading, right? And options and all that sort of stuff, and margin. To buy now, where margin levels are pretty much at record highs, right? The stock market is right around a record high. Bitcoin's still quite a ways off of record high, but it just set record highs, a month ago or a few months ago. Ethereum, same exact thing. I think Ethereum set a new record high within the past month or so. So, the growth rates in 26 are going to get harder to push up. Like, they could still come in with nice revenue growth based upon anybody's standards, but it's not going to be like up 129% year over year type numbers, right? Doubling up the revenues. And so you'll have a slowing of the revenue growth rate in 26. And then if we ever got into like a bear market in 27 or something like that, then you could really talk about major problems for the revenues. And then you'd have a massive collapse in the stock. And when we're talking about a stock like Hood, just understand that stock could go down 50 to 80%. In 12 months. It's not like, it's just, it just goes down 10, 15%. It could go down 50 to 80%, right? And so I'm just not willing to step in at this stage of the market. If we were in a different market, I would be like, dang, the company has its stuff together. How Hood handles the next bear market is going to be very important for the long-term trajectory of Hood stock. If we're talking about Hood eventually becoming a $300, $500 type stock, how they handle the next bear market is going to be really important whenever that next bear market is. If they handle that well, they're able to keep the business model very profitable and have revenues maybe go down a little bit, but not like plummet. Then we're talking about Hood in the next bull cycle could be a $300, $400, or $500 stock. Okay, so that's what's going on there. Hood's a very impressive company, man. The historic turnaround in regards to that. And it is a stock I'd be willing to own nowadays. I just don't want to buy it right now. But could I own Hood someday? Oh, I could absolutely own Hood someday, maybe. Tom Lee, next one up here.
It's good to have you. Welcome back.
Yeah, thanks, Scott. Good to see you.
So the market obviously assumes that this is all going to happen. The government's going to reopen, and we're just going to get back on our merry way in the stock market. That's certainly what the trade says today. Am I right?
Yeah, I think there's a certain measure of relief because the shutdown robbed us of visibility on the macro data. And of course, there's economic hit and they're suffering because, air traffic is slowing. So I think for many reasons, I think this shutdown was a problem for investors.
So what about now between, now and the end of the year? It's the AI trade that really seems to be debated. How do you feel about it heading into this final stretch?
I think it's still in really good shape fundamentally. We know there's a lot of visibility for AI spending, and we know there's still innovation and gain of function taking place with the models. So to me, it makes sense that there's still a payoff coming. I think one of the issues that investors are going to grapple with is even though they may say AI stocks are expensive, NVIDIA still only trades at 29 times forward earnings. I mean, it's still cheaper than Costco, so it's hardly a bubble valuation.
No, but I don't think when they talk about the valuation of AI stocks, they're necessarily talking about NVIDIA. I think you would agree with me on that. They're more so talking about names like Palantir and some others where you could easily say, yes, their earnings have been great and the story's incredible, but at some point you're only willing to pay X for a stock, and maybe that one's gotten a little bit too rich. Using that as an example of the kind of names they're talking about.
Yeah, I mean, I think Palantir is an example of what they call like an N equals one company. You've got a founder-led business. developing products that really seem like magic for the companies that adopt it. So, should this just be getting a softer multiple? I don't think so. And Palantir's opening up so many markets, and if it was a venture capital firm, they'd be getting, potential carry for how they transform businesses. So to me, I think that this is still a market discovering, how to define the valuation model for Palantir. But to me, that doesn't mean it's a bubble. People would have said that about Tesla in 2018 because it looked incredibly expensive, and the stock in Tesla has been a huge performer since then.
But what was last week about then, do you think, at its heart?
Well, I think at the heart is the market wobbles. And so when the market wobbles, two things, one is they start to take shots at the leaders, right? Because they try to take down the leaders thinking that's what leads us down. But the second, it really highlights the grim reality that we're about to have a third year of double-digit gains. The S&P's up 80% over the past 3 years, and funds are measured on 3-year performance. Only 21% of fund managers are beating 80% over that 3-year period. It is one of the worst ever periods for fund managers. And so they'd rather see the market fall so that it falls to their performance level. I think what's more likely, of course, is the market follows a seasonal pattern, which means there's going to be a lot of chasing into year end.
Don't you have any concern at all about the level of money that these companies are spending on their build out, and now the new wrinkle of tapping the debt market rather substantially to help do it?
Scott, yes and no. AI is proving to be a scale game. It's not like you and I could start a garage and make a model competitive with OpenAI. We need to have scale and a lot of chips. That's really the model that was required for telecom infrastructure and for energy infrastructure and, of course, for internet infrastructure and even fiber. So it makes sense that a handful of players are really playing a big role. And just like in the energy system, there's 8 majors. Everybody spends money on the 8 majors, and the 8 majors pay a smaller ecosystem. So I
disagree with Tom Lee. Disagree with him quite substantially here, okay? So the way he kind of frames AI is, the ones that spend the most and buy the most chips are going to be the ones that win, okay? Listen, that's not how this works. That is not how this works. It's never been how this works, and this will continue. Look at a company like Palantir. Palantir, you can make a strong argument, is winning the most at AI, right? At least in the software space, if we want to put them in that space, okay? They've been loading up on NVIDIA chips. They bought, $100 billion of NVIDIA chips, and that's how they all of a sudden have a successful product. No. And so, by just spending the most, people think like that company's going to win. No, and it doesn't matter what technology we've ever dealt with. Like, it's not how it works. The company with the best solution and it knows how to market it the best, they're the ones that win. Doesn't matter. Another company could spend $1 trillion on the technology. If some other company understands the best way to go about it and understands marketing better than the other company's going to win. One that spent a fraction of what the other company spent, essentially. And so that will be no different than how with this AI game, there's going to be some companies that spend fortunes and don't get much out of this. There's going to be other companies that spend very little on NVIDIA chips and AMD chips and things like that and might end up actually being huge beneficiaries of AI and win massively. So it's just how it is, man. It's just how it is. I don't know what else to tell you. Okay, next one up here. Ed Jordani.
Thought about you a couple of times recently, Ed. Number one, I thought about you when we basically were at 6,900 on the S&P. And I was thinking, wow, Jordani was 7,000. And actually, you think it could even go further than that, maybe by the end of the year. And then I thought about Tom Lee, who said he had similar targets, but said near term, definitely going to be bumpy because of the AI trade. And people were definitely worried about AI. Is that finished, or is there more to come in terms of just that particular sector?
Yeah. Tom and I have basically been looking at the market the same way. And a week ago, when I saw that the bull-bear ratio that Investors Intelligence puts out was over 4, I concluded there are too many bulls. And it looks like we cleaned out some of the bulls last week. But yeah, I think this is kind of a buy in the dip market, particularly in AI. I know there's a lot of nervousness about AI, but that's a good thing. In the late 1990s, when I was around during the bubble, the tech bubble followed by the tech wreck, nobody saw the tech wreck really coming. Nobody was really worried about a bubble in the market that I can recall. Not the way it is today, where everybody seems to be worrying about it. But I think AI is all right. I think it's basically an app that has widespread applications. And what the payoff is actually in the cloud. The cloud providers are making a fortune as a result of AI.
I was thinking that too. That I'm always trying to figure out what the hardest thing to embrace is, because that's always the right thing. You know, when a stock, you feel like you're ready to get sick to your stomach. That's probably when you should buy instead of selling it. It's almost always like that. So my idea is maybe we still don't understand how transformational AI could be down the road, and we could still be it. But we won't know for quite a while. What fascinated me about your comments, Ed, was how strong earnings have been. In fact, you could say that there's a floor underneath this market, not based on multiples expanding, which could happen because of the Fed, but based on the E side of things, much better than people thought.
Yeah, well, I am an economist, but somewhere along the way, I also became a strategist. And I always found economics a little bit difficult because there's so many variables you have to forecast. When it comes to strategy, as you said, it's really PE times E. It should be that simple. And it's very simple to forecast using that model. Getting it right is where the trick is. But on the E side, it's been phenomenal. I mean, you would think that with all the commotion coming out of Washington, the geopolitical commotion, the pressure on margins from tariffs, that this would be a bad year for profits. Actually, it's phenomenal. We're going to have record highs in S&P 500 once again for the third quarter in a row. And the analysts' expectations just keep getting beat dramatically. So, for example, in the current quarter, the current earnings season, analysts expected an increase of about 6.5%. It's coming out 14% on a year-over-year basis. So you're absolutely correct. I think that the earnings are there to keep the market going. And in a sense, we've had an earnings-led melt-up, which is, of course, the kind of melt-up that you really want.
Yeah. It'd be nice if things were based on something like multiple expansions. But what do you have the forward S&P multiple at right now, approximately?
Well, right now, the actual forward PE is running around 22 to 23. It's been there on and off. I mean, when we came out of the pandemic lockdown and the Fed came in with its monetary easing to help us get through it all, we saw that the PE zoomed up to 22. And so it took about 6 months to get there. And here we are back at 22. I know a lot of people are uncomfortable with that, but, a lot of that obviously is the Magnificent Seven. They're selling at 30 times forward PE. The S&P 493 is selling at about 1920. That's not cheap, but it's not crazy.
Yeah. So you said.
Okay, let's finish this off.
1,000 by the end of the year. If you change that you should have stuck to all. Yeah.
No, the basic bottom line of it all is we're in a bull market. It's been a volatile year this year, but at the end of the day, we're at all-time record highs in the market in the past couple of weeks. And I think there could be a good, solid Santa Claus rally. I tend to focus on November and December rather than on the Thanksgiving to Christmas period. And that usually adds about 4 percentage points.
Okay, so let's talk for a moment about Mag 7, because those are the ones that are most impactful to the market by far. Let's talk about them. You know what? Let's go down the list. We can broaden it out even a little bit. We can say big tech in general. So I have a big tech watch list here. So how are we feeling about these big tech earnings for next year? Apple should have very nice earnings growth next year, no doubt in my mind, based upon this iPhone cycle. Adobe, as stable can be, they should have very nice earnings growth next year. Oracle should as well. They're spending a fortune on CapEx, but as far as their earnings, they should strengthen quite substantially next year. Intuit, yes, consistent company, kind of like an Adobe. CRM, yep. a huge increase in profitability. IBM, probably. I don't track them on a high level, but I would say probably earnings will be up very nicely for them next year. Netflix, yes. Meta, yes, but how crazy does Zuckerberg take the spending in 26? If he doesn't go that crazy with it, then EPS will skyrocket for the company. If he goes aggressive, then EPS won't grow nearly as fast as it should. We'll see, but should grow earnings very nice next year. Amazon, yeah, earnings should skyrocket next year. Microsoft should be a big up year. Palo Alto Networks, likely, yes. Snowflake is a whole situation. We don't have to talk about that one. Uber profitability should continue to skyrocket next year. Vago, yes, should continue to skyrocket next year. Tesla's a complete wild card. Probably, I don't know if they're going to be down again earnings next year, but it's not looking great for them. Google McDougal, earnings up substantially. Shopify, earnings should be up substantially. AMD should be a rocket ship ride in regards to their earnings next year. NVIDIA should be up as well, nicely up. Not nearly as extreme as the past few years, but they should still have nice earnings growth next year. MU should be a rocket ship ride. And then Palantir, rocket ship ride. So the earnings story is there for next year. When it comes to big tech, which those are the stocks that matter the most in the market. They just do, man. The other stocks, like, what Elf does, what Celsius does, what Nike does, those sorts of stocks, like what Whirlpool does, whoever, those stocks just don't matter to the market. They just don't. Those big techs do matter. Their market caps are massive, and they're what a lot of people are invested heavily in, especially if they own index funds, which is what many people do. Okay, Stephanie Link.
The Senate's getting closer to a deal to end the government shutdown. Still has to pass the House. So there's a few more hurdles. It's going to take a few more days. Does that erase some of the other concerns like inflation and, of course, valuations? Is this good enough to kind of take the bull market and put it back on track, the idea that we might have a deal here?
I think it does. The word of the day is seasonality, and that's because
she's already got her Christmas tree up. What about you guys? You already got your Christmas trees up? Come on, man. They're getting them up early.
The fourth quarter, on average, cumulatively, over the past 50 years is up 8.5%. So I think you use the volatility that we've seen so far in November, which, by the way, we were supposed to get volatility in September and October. We never got it. Markets actually did much better. So you use the volatility that we've seen so far to be adding into this seasonal strength. You add to financials, you add to energy, you add to industrials, technology, discretionary. And that is mainly because the economy is still on very sound footing, and earnings growth, Frank, running up 12.5%, and revenues up about 8%, margins better than expected. So I think you buy any pullbacks, where especially if numbers are going higher, to those stocks that have kind of pulled back with the overall broader market.
All right. To your point, the economy is very strong. If you look at any estimate for GDP for this quarter, it continues to be strong. I believe Atlanta Fed actually increased it by like a basis point last week as well. But I want to talk to you about something that Bespoke put out. Now, this is pretty interesting. You look at the S&P 1500, which I know you're familiar with, mid caps and small caps in there. Communication services and tech, they're both in bear market territory, more than 20% from their 52-week highs. Is that concerning as you look deeper down the cap that we're seeing these kind of pullbacks in so many names?
I'm actually pretty encouraged that we're seeing this broadening out that we've all been talking about. It's actually been fits and starts in terms of the broadening out. And so I think you want to own tech. I think you also, though, want to own all the other sectors that I mentioned that should outperform into the end of the year. You could add mid caps and small caps if you like. I don't. I actually would rather own more cyclical companies on the large caps side. Both have the same kind of factors in terms of how they trade. So I'm encouraged. I think it's going to last into the end of the year for sure. $7 trillion of cash on the sidelines, Frank. I don't think it's all coming into the market, but it certainly is a nice tailwind.
All right, that's a fair point. We have a lot of earnings this week, including big tech earnings. CoreWeave, Cisco, Applied Materials, Sony, SoftBank. Any of these have the potential, upside or downside, to have a market impact like we saw with Palantir?
Yeah, smalls and mids, that might be more of a story for 26 and beyond, because a lot of those stocks are still down big. And so those could be, tax loss harvest type stocks. Those are something to keep in mind. I appreciate y'all for joining me. As always, thank you so much for being here. If you look at Applied Joint Prep Stock Group, Private Wealth Group, get access to 1000xstocks.com, all that good stuff. Before we close that down for the year, there will be the pinned comment down there. Much love and have a great day.